Hi, Pri. Arnold, thank you for joining. 1 year on, it seems that commercial real estate exposures are once again raising concerns in the banking sector, and two names have been under the spotlight. So I'll guess I'll start with Pri. Pri, you cover Japanese banks from a credit perspective. Can you tell us a bit about the specificity of Aozora's exposure to commercial real estate, and if that could mean that there's a broader issue with it on the Japanese banking sector?
Yeah, Renato, so I think that's a very timely question. And the challenges faced by certain segments of commercial real estate are almost universal, barring for maybe a few hotspots like Singapore, the UAE, and possibly Japan due to their lower borrowing costs there. The office segment, for instance, suffers from high vacancies and also high borrowing costs. The commercial mortgages are also much larger tickets when compared to, say, residential mortgages, for instance. So the concentration risk is there for the banks to manage. This is especially the case for a smaller bank like Aozora. But what's unique about Aozora is their very high loan to values or LTVs. Most banks that um, and that goes for the Japanese banks as well. And typically, most banks will lend about 50 to 60% LTVs for commercial mortgages, but in this case, in the case of Aozora, their LTVs are much higher. They're about 80 to 90%, and the challenge with that is it doesn't give them much leeway to deal with a delinquent non-recourse loan. And I think it's this specificity that is unique, and I don't see it playing out at other Japanese banks.
Perfect. Thank you for that, Pri. Arnold, on your side of the Atlantic, you have New York Community Bancorp, which was just recently downgraded to junk. How do you see it? Is these exposure something specific? Could it become more systemic? Is the system ready for this? What do you think?
Yeah, again, like another year, another something happening, right? But I think for NYCB, I think it's a little more, I guess, idiosyncratic. I mean, everybody has exposure to CRE, but to a lesser degree, right? And for NYCB specifically, we think that a downgrade to junk, we think could threaten its big bank status. Right above 100 billion, you have higher equity and debt requirements, and with their bond spreads really wide and at junk ratings, I think it'll be a little bit hard to issue that 4 to 5 billion, necessary for the new minimum debt requirements for regional banks. More for the bigger banks, right? The bigger U.S. banks. We think there are three reasons why we think they're better protected this year versus last year. One is wider bond spreads, right? Like basically, the U.S. banks, U.S. bank financials trade about 10 wider to the overall index versus 10 tighter actually in 2021. Second is there's regular stress testing, right? So this is the kind of stuff. Asset quality, right, is a concern now, and the biggest guys are stress tested every year on this. So this is kind of the thing that might happen, and it is starting to happen, right? So we think they're better prepared, and then lastly, it's the capital levels have risen from last year, right? The banks have been really conservative with share buybacks and everything. So capital levels are higher, and so we think they're better prepared this year.
Perfect. Good. It sounds safe enough then. Thank you very much for that, Arnold. I should flag that this Thursday, the 15th of February, we will be discussing US banks behemoth versus rates and regulation with Arnold. And that happens at 4 p.m. GMT. Check your Bloomberg seminar page to register, and we'll see you there.